Thank you so much. Kevin's also, like I said earlier, from Stitch Fix. He's a senior software engineer there. So Kevin, take it away.
Thank you. And thank you for inviting me to speak today. I really appreciate it. Yep, as you mentioned, today I'm going to be talking about crypto, blockchain, and DeFi, engineering the Internet of Money. Let's make sure. All right. My name is Kevin Weaver. During the day, I'm a lead software engineer at a clothing e-commerce company called Stitch Fix, as we just mentioned. There, I build customer-facing applications that help people find the clothing that they love. At night, I like to draw pixel art, play video games, and learn about computers, the internet, and technology. Ever since I was a kid, I've always loved video games. Growing up, I was raised on games like Super Mario Brothers. The series has given me a frame of reference and a deep appreciation for how quickly technology progresses, evolves, and improves. That appreciation for technological change has grown into a true fascination, and it drives a lot of my personal interests today. Witnessing the speed of exponential innovation gives me a source of optimism and hope in a world that otherwise seems to be on the brink of collapse. But before we get started, I'd like to set the stage a bit. Money is an uncomfortable topic, and crypto in particular can be polarizing. Like anything else, crypto is multifaceted and nuanced. There are both positive and terribly negative aspects to cryptocurrencies. Online, you will find the full spectrum of crypto enthusiasts. One subgroup of the crypto community called Bitcoin maximalists rally around the currency with religious zeal. They believe Bitcoin will be the only currency in the end, that one day all world currencies will collapse into Bitcoin. This overly simplified worldview is grounded on fundamentalist libertarian ideals. Bitcoin maximalists, or maxis, often meme about a future Bitcoin citadel, a small utopian monolith reserved for those who bought Bitcoin early. To me, this is about the least desirable or interesting future I can imagine. As with most cultist groups on the internet, they often have little interest in meaningful or nuanced fact-based discussions. They typically aren't interested in acknowledging the enormous pressure that Bitcoin puts on an already tipping scale toward climate change. Instead, they skate around the issue with quips like, have fun staying poor. The crypto space is similar to much of the tech world. It lacks empathy, diversity, and is brimming with tech bro culture, toxic masculinity, and sexism. Apologists often attempt to excuse this behavior for some hand-wavy greater meaning. While Bitcoin maxis are often the loudest, their ideals and culture encompass only a small subset of the greater crypto community. I believe this context is incredibly important while entering the space. At Stitch Fix, we often begin meetings with a clearing, a moment to bring up anything that's on your mind that may be pulling your focus or causing discomfort. When Catherine and Amanda gave me the opportunity to speak today, I was truly honored and excited. Giving any sort of technical talk, I don't like to assume much prior knowledge on the topic. Yes, crypto has been around for years, but it can feel like a niche, easily ignorable field for many. It is also not uncommon to associate the topic with toxic and unwelcoming experiences. Here's my clearing. My excitement for giving this talk comes with the anxiety of being a tech-loving white guy attempting to explain Bitcoin to a group of brilliant and diverse women and non-binary software engineers. I hope to achieve the right amount of depth. Please feel free to reach out with any questions or feedback. My goal for this talk, and as an ally in general, is to bring more diversity to the table. I believe this technology has within it the capacity to bring about large and meaningful change for marginalized and underrepresented groups around the world, to bank the unbanked, to tear down the walls of a financial system built on the premise of exclusion and make access to more robust financial services universal, to evolve from a system controlled by a handful of old white dudes behind closed doors to one that is owned and operated by the entire world. To be transparent, I own cryptocurrencies. I personally find hands-on learning to be the most effective for me, and I believe in the long-term potential of the broader crypto space. That being said, I have no idea which projects will succeed or fail. Please do not treat any of this as investment advice. I like to give technical talks because I believe that educating and mentoring others is a fundamental component to the process of my own learning. If I can't explain something, it's because I don't truly understand it myself. The only investment I hope to encourage today is the investment of curiosity, education, and time. This topic is not something that will make sense from a 30-minute talk or 30 talks. If you choose to fall down this rabbit hole, be patient and kind to yourself along the way. New technology is complicated. Remember that you are not an imposter. You are a badass engineer learning about the future of money. I've crammed a lot of information into this talk. I'll make the slides accessible, so don't feel like you need to absorb everything today. With that, let's begin. Our scene opens at the brink of the 2008 financial crisis. The story is likely familiar to you. Whether you understand the details of how it occurred, felt the effects personally, or are simply accustomed to a financial system built to protect the interests of the few, the housing crisis sent a shockwave through the US financial system and the global economy. A perfect storm of regulatory negligence, misaligned incentives, and outright greed. After the dot-com bubble in 2000, low federal interest rates incentivized banks to sign customers up en masse for variable interest rate mortgages. Intermittent and low income were no problem, and a mere signature and pulse were often all that was necessary to sign customers up for mortgages with interest rates that would quickly balloon. These subprime or high-risk mortgages were then wrapped into securities, given AAA ratings, and purchased by banks with little regard to the potential risks these mortgages would expose to the funds of their customers. Banks began to over-leverage these assets to the point that any downward deviation in the price of housing would be catastrophic to the banks and the entire economy. Interest rates began to climb and homeowners began to foreclose. Housing supply grew above demand and prices collapsed. The lower and middle classes were swiftly buried under inflating interest payments for homes that had lost their value abruptly. The collapse crippled the global economy and kicked off the Great Recession. An estimated 10 million homeowners lost their home to foreclosure sales in the US between 2006 and 2014. These homes now awarded to the banks that enabled the crisis. Despite collapsing the global economy, banking executives would receive no blame. Instead, the same executives that had played a part in creating this perfect storm would receive massive stimulus directly from the government. The banks were simply too big to fail. Once bailed out, financial institutions awarded their top executives nearly $20 billion in personal bonuses as the economy slipped underwater. The problem became abruptly clear. We live with a financial system that privatizes gains and socializes losses. An elite few are capable of risking the funds of the many, and instead of being punished, they are rewarded. Incentives are misaligned. Decisions that impact millions are made behind closed doors, the risks opaque to all. Those closest to the new money spigot always manage to siphon off billions for themselves, and those most in need often end up with nothing. However, the solution is far from obvious. The Occupy Wall Street movement kicked off as people had had enough. They saw the corruption that was occurring in the open and knew it needed to be stopped. But how? The movement slowly fizzled out as it was unclear how to enact real change from the bottom up. As all of this was occurring, in 2009, an anonymous software engineer under the pseudonym Satoshi Nakamoto released a white paper, a technical document for a peer-to-peer cash system known as Bitcoin. The document outlines the design of a new network of computers. Unlike most networks, this new design would consist of all clients, no servers. Instead of relying on centralized server nodes to establish a source of truth for network state, the white paper introduced the concept of a new database protocol known as a blockchain. This new type of open, decentralized database would allow all peers on the network to read from and write to the ledger directly. At the heart of the blockchain lived a consensus mechanism, a series of steps that once taken would generate consensus among the network peers. This mechanism allowed the network to keep track of who owned how much Bitcoin. A source of truth to determine network state would emerge from the network directly without the need for centralized intermediaries or trusted third parties. This consensus mechanism would combine cryptography, mathematics, and economic incentives to create a series of interconnected blocks. Each new block would introduce new data into the network in the form of new Bitcoin transactions. To send Bitcoin from one wallet address to another, a transaction is proposed to the network. Because the full history of the network is visible to all nodes, it is trivial for the Bitcoin network to ensure the validity of transactions being proposed to it. Bitcoin can only be spent once, and only when the sender actually owns the necessary funds. But how can we trust that individual nodes on the network won't attempt to cheat these rules? Hundreds of thousands of network nodes, known as miners, would burn massive amounts of electricity in a ritualistic dance to establish trust on the network. These miners would run what Satoshi called a proof-of-work consensus algorithm. This spent electricity would serve as proof that the miner had put in work to secure the network, proof that real-world value had been irreversibly burned, value that the miner would wager to prove that they had something to lose if they attempted to cheat the network. The blockchain proof of work consensus mechanism aligns incentives between individual nodes and the entire network itself. Miners working against the interests of the network would require more hashing power and electrical consumption than the majority of the entire network. More likely, they'd be wastefully burning electricity and be left empty-handed and empty wallets. It was too expensive to try and fight the network, and much more lucrative to help grow its trust foundation. The beauty of this consensus mechanism was subtle, however. The more nodes that ran the network, the more computers would check the validity of the data. The more computers validating the network, the more trust would be collateralized in the form of electricity. The more electricity burned, the higher the barrier to attack the network and break that trust. A blockchain has the properties such that the more decentralized it becomes, the harder it is to tamper with, and the more its contents can be trusted. The blockchain became the world's first trust machine, a consensus mechanism whose primary purpose was to convert decentralization into trust. The blockchain had created trust as an internet protocol. The first trust machine laid the foundation for the first purely digital yet scarce resource called Bitcoin. Open, public, borderless, neutral, censorship-resistant money had been born onto the internet. Money that was not under the control of a government and couldn't be seized or censored by a middleman. Bitcoin had created value as an internet native content type. Sending value anywhere in the world was now indistinguishable from sending an HTTP request. No banks, no third parties, no gatekeepers, no way to be stopped. It was the first ever separation between money and state. On January 3rd, 2009, the Bitcoin network commenced operation with an immutable, unchangeable rule set. There will only ever be 21 million Bitcoin. This value cannot be changed by anyone, not even Satoshi. New Bitcoin would be issued to miners over the next 100 plus years in a disinflationary curve, having supply every 4 years with an intention to roughly simulate the properties of gold. Included in the data field of the first ever block was the headline of a newspaper in the UK. Chancellor on the brink of second bailout for banks. Satoshi Nakamoto, whoever he, she, or they were, offered a nod toward a legacy financial system in distress. Over the years, the blockchain proved itself extremely capable as a trust foundation. Slow macro trends can be difficult to notice, especially if you're not paying close attention to them. Despite my fascination with the technology, I don't like to dwell much on the price of crypto. Discussing money is uncomfortable and everyone is capable of checking it themselves. However, I do believe that the context surrounding price and adoption may be a relative indicator of how much monetary value and trust humanity chooses to instill in the first ever trust machine. For this, I believe frames of reference are a helpful tool. By February 2021, the Bitcoin blockchain would grow to secure over $1 trillion in trusted value. From nothing, its market cap would soon dwarf over 100 fiat or government-issued currencies, ranking as the 14th largest today. Currencies aside, Bitcoin is now the 8th largest asset, beating Facebook and Tesla. US citizens that converted their $1,200 April stimulus checks into Bitcoin now hold over $10,000 worth of Bitcoin. As the price trends toward a logarithmic growth curve, such a long-term and meteoric rise is challenging to comprehend and display without log scale charts and an exponentially growing y-axis. The price of Bitcoin tends to move in four-year boom and bust market cycles. While we are in the midst of another price rally, remember that it can just as quickly crash again for another 3+ years or longer. Past performance does not mean future performance, though. Be skeptical of anyone that tells you that they know what Bitcoin will do moving forward. Despite a constant flow of media outlets disparaging its volatility and pronouncing it dead over 400 times, Bitcoin would go on to become the best performing asset of the decade. The green lines in the middle graph at the bottom, just above 0% return on investment, represent bonds, gold, and the S&P 500. Bitcoin, on the other hand, experienced a roughly 9 million % return on investment over the last 10 years. Fintech companies like Square, Venmo, Robinhood, and PayPal, payment networks like Visa and MasterCard, even begin to adopt and offer the technology to the masses. Cities and countries would begin accepting it for tax payments, paying government salaries in it, and competing on crypto friendliness. Over the years, other countries like India would attempt to ban it. China would attempt to ban it multiple times in multiple ways, yet would remain one of the most heavily concentrated users and miners of Bitcoin. As a global industry, it appears that governments can try to remove their country from crypto, but they can't seem to remove crypto from their country. Publicly traded companies would begin to buy Bitcoin and accept it as a payment to secure their portion of the 21 million total supply. The world's largest asset manager, BlackRock, would put it on their balance sheet in an attempt to hedge the inflation of the US dollar. Despite Bitcoin being only 12 years old, 75% of all US dollars were printed after Bitcoin was created. This fact alone would begin to push people to ask more basic questions about the value of fiat currencies and their infinite supply cap. Most of us living in the United States have put very little thought into the potential threat of hyperinflation. Having the most robust financial system on Earth, there really hasn't been much reason to consider it. It's important to remember that we are an anomaly on the world stage. On the left is a list of 28 countries, including China, Russia, Greece, France, Peru, Germany, Zimbabwe, and Venezuela that have experienced hyperinflation in the last 25 years. During a hyperinflationary event, the average time for prices of goods to double even just once in these countries, about 20 days. The blockchain is considered by most to be one of the most profound and disruptive technologies to emerge since the inception of the internet. As the 38th director of the US Mint stated, Bitcoin and the ideas behind it will be a disruptor to the traditional notions of currency. In the end, currency will be better for it. We have elected to put our money and faith in a mathematical framework that is free of politics and human error. Blockchain technology isn't just a more efficient way to settle securities, it will fundamentally change market structures and maybe even the architecture of the internet itself. But our story doesn't end here. Bitcoin didn't solve all of the problems that were exposed during the 08 financial crisis, and the problems it created were even more dangerous. It's not easy to calculate the electrical consumption required to power older fiat financial systems. Fiat currencies are valued by the trust in the economic capacity of the underlying nation state. That trust comes in the form of both bank servers and ballistic missiles. But Bitcoin is nothing if not transparent. To secure the network, Bitcoin burns more electricity than New Zealand and Belgium combined. If Bitcoin were a country, only 30 other countries would use more electricity. We don't just need more transparent money. We need a more transparent financial system for a global society and an internet age. Most importantly, we need one that doesn't light our planet on fire in the process. Bitcoin was only the first act of our story, though. The prototype was out of the way, and engineers were only just beginning to understand and harness the true potential of the trust machine. As with most technology, innovation quickly took its course. In 2013, only 2 short years after the launch of the Bitcoin blockchain, a 21-year-old software engineer named Vitalik Buterin released a white paper for what he described as a next-generation smart contract and decentralized application platform. The new blockchain would be called Ethereum. In computer science terms, Ethereum is what's known as a Turing-complete virtual machine. This means that Ethereum is an internet-based computer, a single symbolic computer that runs on tens of thousands of physical computers. As a shared world computer, the Ethereum virtual machine, or EVM, allows anyone to read from and write to its data. A general purpose, credibly neutral trust machine that could be used as the foundation for building a new breed of decentralized applications and money protocols. If Bitcoin was the first money for the internet, Ethereum is the first financial operating system for the internet. Bitcoin was the calculator, Ethereum is the computer. At the launch of Ethereum, it utilized a similar consensus mechanism as Bitcoin. Miners were incentivized to burn electricity, run the network, and be rewarded with the network's native asset, known as Ether or ETH. Unlike Bitcoin, which is both the name of the network and the currency, Ethereum, the network, was the foundation for a different named asset, Ether. To request the Ethereum virtual machine to perform some function, users pay miners in Ether for the work of running the computations on their machines. To ensure that more complex and resource-intensive actions could be priced appropriately for miners, all basic computations and mathematics are assigned a value in units called gas. Unlike Bitcoin, Ether isn't just new money. Ether, in the form of gas, is the fuel that powers the Ethereum virtual machine. Applications built for Ethereum consist of what are called smart contracts, code written in a flavor of JavaScript used to store, access, and manipulate data on the EVM. This data can exist in the forms you would expect: booleans, integers, strings, hashes, arrays. But Ethereum offers an important distinction from a typical computer. Being built on top of a blockchain gives Ethereum applications the ability to produce the same digital asset scarcity as Bitcoin, this time with a much more expressive, flexible programming language under the hood. Suddenly, anyone in the world with access to a computer and the internet had the ability to create new digital assets and currencies with only a few lines of code. With the help of new standards like ERC20, the complexity involved in programming the flow of money collapsed from an endless supply chain of clearinghouses, payment providers, banks, and middlemen taking their cuts to a single JavaScript transfer function. With the ability to mint new cryptocurrencies in minutes, accelerations of crypto projects hit an inflection point. This new superpower was used to create hundreds of new cryptocurrencies and tokens in 2017. Projects claiming to solve all sorts of problems with the blockchain would launch their own cryptocurrency as a fundraising mechanism through a process known as an ICO, or initial coin offering. These projects were oftentimes nothing more than a WordPress, a white paper, and a whimsical dream of decentralizing X, Y, or Z. In just over a year, these half-baked projects would soak up billions in investor funds, but most of which didn't make it off the ground. Many were outright scams. This euphoria led to a massive spike and subsequent crash in the price of Ether and the entire crypto market. Ethereum left the limelight, and investors left the space feeling burned and in the red. But this wasn't the end for the Ethereum. Far from it, in fact. The bear market would give serious engineering teams the necessary time to breathe and build. With the ICO mania out of the way, builders would spend the next 3 years building and creating an entirely new financial ecosystem that would come to be known as DeFi. DeFi stands for decentralized finance. With the new superpowers granted by Ethereum, developers were able to emulate all the remaining core components of the traditional financial system, or CeFi, standing for centralized finance. Money, central commercial and investment banking, exchange, brokerage, insurance, payments, and asset management. All of this can be done today in DeFi without a traditional bank or middlemen. Witnessing the inception of DeFi has been one of the most fascinating experiences of my life. To even scratch the surface of everything that was being built required just about every night and weekend for the last 3 years. Like the internet itself, it's past the point of any one person being able to keep up with it. Regardless, I'll attempt to highlight some important milestones and breakthroughs that occurred in DeFi during this time. The first major breakthrough on Ethereum was the concept of a decentralized autonomous organization, or DAO. DAOs are an internet-native alternative to the hierarchical centralized corporation. With the ability to create and program the flow of money, all of the necessary groundwork had been laid to create a new model for organizations. Today, hundreds of DAOs exist in every shape, size, and purpose. Simple investment DAOs were the beginning. With a few lines of code, decentralized groups of strangers on the internet would begin to pool capital and use democratized token-based voting mechanisms to direct funds into projects that seemed promising. After investment DAOs came more interesting instances of this new structure. One of the first was MakerDAO. Maker is a decentralized organization of developers and builders that created the first decentralized stablecoin called DAI. Stablecoins are cryptocurrencies that peg their value to a fiat currency. One DAI equals $1. With the birth of DAI, anyone on Earth with access to the internet gained the ability to permissionlessly own and hold US dollar. Today, there are stablecoins pegged to many of the top fiat currencies. Among the obvious utility of financial stability, stablecoins act as a bridge from CeFi into DeFi for people coming from all backgrounds and financial systems. Eventually, other DAOs would create other synthetic derivatives. Like stablecoins, they would peg their value to real-world or off-chain assets. Price exposure to commodities like gold, oil, and silver, as well as equities like stocks and index funds, were suddenly globally accessible. But with this new breed of stocks, there isn't a middleman. No one to halt trading or delete the buy button. No one to change the rules mid-game when the wrong people start winning. If you like the stock, you can buy the stock. In addition to traditional financial assets, a new breed of tokens known as non-fungible tokens, or NFTs, were born. Digital pets, video game items, playing cards, decentralized website domain names, and collectibles joined the digital asset scarcity revolution. All global assets that didn't fit the mold of traditional currencies now had a way to accrue value and live on the internet. NFTs have suddenly given artists the ability to release limited digital print runs where rules around ownership of the art are programmed directly into the tokenized artwork. Musicians like Imogen Heap are now using NFTs and smart contracts to monetize and distribute their own music without the need for middlemen. Next came Gitcoin, a community-run open source funding platform that would allow developers to monetize their skills while working on open source DeFi projects. Gitcoin utilizes a concept called quadratic funding to spread out and boost funding disproportionately for projects with more individual donors. In the GIF on the right, green nodes are grants and red nodes are donors on the Ethereum network. Today, a handful of the top money protocols automatically divert a small portion of their fees toward Gitcoin with the hope of identifying and funding more grassroots projects and cultivating a lush, self-funding, open source ecosystem of new money protocols. The next major breakthrough came with the concept of an automated market maker. In traditional finance, a market maker is a centralized company that stands between buyers and sellers to create markets. In crypto, an automated market maker removes the company from this equation, allowing both halves of the market to trade in a peer-to-peer fashion. One of the first automated market DAOs is a decentralized exchange called Uniswap. If you think of a traditional financial exchange like Robinhood or Coinbase, its purpose is to bring together buyers and sellers of stocks and cryptocurrencies. To do this without relying on a traditional order book, Uniswap created what is known as a liquidity pool. Liquidity pools allow traders to swap between currencies like Ether and DAI without pairing specific buyers to specific sellers. Instead of trading fees being captured by a central third party, they are paid back out to the network to liquidity providers, general DeFi users that provide funds to facilitate this exchange and earn interest in return. DeFi users now had the ability to permissionlessly swap between any digital asset, as well as earn interest in the process. Then came flash loans, a new DeFi native financial primitive. Borrow millions of dollars in funds with no collateral, as long as you return it in the same transaction. Flash loans are a useful tool for protocol engineers to combine multiple complex financial maneuvers into a single transaction. They have also been the source of massive protocol hacks that have lost millions of dollars in user funds. With great power comes great responsibility. Each week, fascinating new money protocols launched, further improving and reinventing the last. Protocol DAOs like Compound and Aave introduced decentralized lending and borrowing. Curve and Balancer created new adjustable and specialized liquidity pools. Yearn and Token Sets created tools for automated portfolio management. By the summer of 2020, DeFi had reached a critical mass. There were suddenly dozens of new money protocols and financial tools to use and begin providing liquidity and earning interest. DeFi had finally given investors a reason to come back to Ethereum. Yield farming is the term used to describe seeking out high interests through lending, borrowing, staking, and liquidity providing in DeFi. Over the last 8 months or so, yield farmers have earned investors anywhere from 2 to 20% annualized interest on US dollar stablecoins. More speculative or risky assets can earn up to hundreds or even thousands of percent annualized interest today. For context, during this time, my traditional CeFi bank dropped my interest rate down to 0.01% and eventually went out of business. Yield farming can be very risky, however. Network congestion has increased gas fees to make it cost prohibitive for low capital users. Like all of crypto, it is not something I would recommend without an in-depth understanding of the risks involved. Eventually, though, I believe the term yield farming will likely be phased out for the more traditional title, a DeFi checking account. With each of these new decentralized organizations and money protocols came the demand for decentralized governance. Instead of single engineering teams making all of the decisions, protocols would issue governance tokens to the people whose interest most aligned with the protocol's success, the users of it. This came to be known as an airdrop, rewarding DeFi users simply for utilizing and being opinionated about these new financial tools. For instance, Uniswap's retroactive airdrop awarded $1,500 in Uni tokens to thousands of users, to anyone that had used the exchange even once before a certain date. DeFi is the only field I am aware of that will literally pay you to learn about. The concept of rewarding users of a service directly and handing off governance and decision-making capabilities in this way is incredibly foreign to centralized companies. Similar to blockchains, though, DeFi protocols become more trustable as they become more decentralized. If a single engineer or team of engineers holds the key for a protocol, other money protocols will not be incentivized to build on top of it. Over time, the more credibly neutral a money protocol becomes, the more likely it will sink to the bottom of the protocol stack and exist as foundational infrastructure. This concept is known as the protocol sink thesis. Total value in DeFi is now over $40 billion and growing rapidly by the day. Of course, it's unclear how long this phase of parabolic growth will last. At some point, I anticipate we'll begin to see the same euphoria and subsequent reality check as both the 2018 crypto market crash and the dot-com bubble before it. New technology is no stranger to overexuberance. If you're looking to get rich quick, you'll probably just get poor quicker. Investing in new technology should be viewed in the same long-term time frame and context as the impact of that technology. This growth phase is still important for DeFi regardless. This new influx of capital will fund teams of engineers for the next few years to continue building over the next market cycle. Let's just say that a lot of teams are hiring right now. The final component of DeFi that I'll hit on today is a concept called staking. You can think of staking as a sort of internet bond. Similar to a US Treasury bond, investors choose to lock up their assets for some amount of time and earn interest in the process. For government bonds, these funds are used to bolster and strengthen the US economy. In the case of Ethereum, staking is used to strengthen the security of the network. Ethereum is currently undergoing a multi-phased process of converting its underlying consensus mechanism from proof of work to a much greener alternative called proof of stake. With this transition, the electrical consumption of the network will drop to only a fraction of a percent of what it is today. This new design allows the network to be secured with bare bones computers, Raspberry Pis, and Ether locked in smart contracts. No more burning electricity for the sake of securing the network. Staking has already begun, and archaic mining on Ethereum will soon be a thing of the past. How was it that engineers were capable of creating an entirely new financial system in just a few short years? The short answer is money Legos. All of DeFi exists in open source code on an open source platform with a transparent state and execution environment. This allows each new money protocol to act as a new composable money Lego for other engineers to leverage and build off of. Even combinations of different Lego sets create new reusable building blocks for the next protocol. This composability means the difference between linear and exponential innovation. Traditional finance is a nested series of black boxes. Every new project must essentially start from scratch, recreate the wheel, and raise millions of venture capital to do it. In DeFi, radical transparency and composability means when one person invents flash loans, every protocol now has access to flash loans. Despite the ferocious speed of DeFi, though, these are still incredibly early days. It will take years for all of the necessary infrastructure to be built and scaled to handle the total addressable market of DeFi. Regardless, the world is waking up to the power and value of relocating trust from people into programs. Unlike the conditions that allowed for the '08 financial crisis, we are moving to a system that is built on a foundation of transparency. This transparency allowed for the creation of decentralized corporations that are more fair and equitable for society. This transparency makes DeFi more efficient. Transactions are near instant, and accounting is fully automated in real time. There's no concept of quarterly reviews. New financial statements are released every 12 seconds with each new block on the Ethereum blockchain. Most importantly, this new system is globally accessible. Without asking for permission, all 4.6 billion people with access to the internet today now have access to a robust financial system, regardless of their geography and nationality. There are tons of resources online that will guide you down this rabbit hole. Ethereum.org is a great place to start. Again, I will make these slides available to reference these resources. A few more resources that I've found helpful are the movie Trust Machine by Alex Winter, the book How to DeFi by Darren Lau, YouTube Talks by Andreas Antonopoulos, and the podcasts Bankless and Unchained. Additionally, feel free to check out my own podcast called The New Blocks on YouTube, Spotify, and the usual podcast platforms. Each 30-minute episode, my co-host Andrew and I break apart a single concept and take one small step further down the DeFi rabbit hole. DeFi is better with diversity. SheFi, She256, and Meta Gamma Delta are three communities focused on cultivating diversity and inclusion in DeFi. The flavor of JavaScript that powers Ethereum is called Solidity. Check out Crypto Zombies for a great tutorial. From there, tools like Scaffold ETH give you everything you need to get started building your own decentralized applications. A great way to get hacking is to join a hackathon organized by ETH Global. Their next two hackathons are scheduled for March and April. In October, I had the amazing experience of building what's known as a liquid staking protocol with engineers from 4 different countries around the world. DeFi is a truly global movement. Whether it's Ethereum and the money protocols that exist today, or an entirely new set of trust machines and money Legos that haven't yet been created, I believe that we are witnessing the world's financial assets being uploaded onto the internet to a new foundation of trust and transparency. I believe that DeFi is a financial revolution for the internet age, a new chapter for money and the internet of money. Thank you.